Good afternoon, good morning. Hello. Thank you for joining this webinar, SFDR, What Actions Should Asset Managers Be Taking Now? This is Barnabas Ax, Global Director, Sustainable Finance and Investing at London Stock Exchange Group. I will be your moderator today. Now, before we begin, a few housekeeping notes. At the bottom of your screen, you will find multiple widgets for you to use and access, such as speaker bios, webinar materials, technical support, and a survey to capture your thoughts and views on the discussion. All widgets are resizable, movable, so please feel free to move them around to get the most out of your screen space. We'll be recording today's session. If you have any questions, and I hope you do, you can submit them through the QA box, which is the question mark in the middle, and we'll try to answer them throughout the discussion. For the best viewing experience, we recommend closing any programs or browser sessions running at the background. This will help conserve your bandwidth. Should you experience any issues, you can refresh your page or reach us via the QA for support. We value your feedback, so would love for you to complete the pop-up survey at the end of the webinar. The webinar recording and resources will be shared via email post-webinar. So, SFDR, PAI, Article 689, PASI, DNSH, all reasonable means, L1, L2, are the dreaded regulatory acronyms that are haunting asset managers and wealth managers in 2021. The Sustainable Finance Disclosure Regulation, SFDR's long version, not only requires smart sale, but also compliance with it as of March this year. I'm accompanied by renowned experts to help to get a better understanding, share a few best practices, and answer your questions regarding the SFDR regulation. I have with me Sherry Madeira, Chief Industry and Government Affairs Officer at London Stock Exchange Group and Chair of Sustainable, now I got this wrong, Chair of Future of Sustainable Data Alliance. I also have with me Anna Devreux, Senior Vice President and Director Fleischmann Hiller, Brussels. She has 13 years of experience with the European Parliament's Econ Committee. Corentin Covidard joins us from Natixis, where he is Regulatory Affairs Advisor, and he is co-author of What Investors Should Know About SFDR, which is also in the resources section. And I also have Andrei Shanavat, Director of Product Management at Refinitiv, and also member of the Task Force for Nature-Related Financial Disclosures. Before we begin, we would be keen to understand your challenges around SFDR. Hence, if you don't mind, we start with a very quick poll. So please choose which is the most applicable to you. We give it a couple of seconds. So answers: what is SFDR? PAI indicator coverage, handling missing values for non-disclosing companies, or do I report as Article 8 or Article 9? So why don't we just advance to the next slide to see the results? I'm hoping it will update soon. Okay. Just navigate back and forth a quick little bit. Oh yeah, here you go. Oh, quite a balanced view. Handling missing values for non-disclosing companies getting the highest percentage. So I guess, Andre, you are going to get a few questions today. So, but first, Sherry, starting with you, what are the objectives of SFDR and what does it mean in practice? And of course, what are the key questions that investors are facing here? If you could just give us a short overview. Thank you.
Great. Thanks so much, Barney. A pleasure to be here. A little daunting to be on a panel with someone who's written a book on SFDR. So I'm looking like I'm going to be learning quite a bit as well alongside our audience. But if we just take a step back first and perhaps set the scene a little bit. So why does the EU care about sustainable finance? You know, this regulation has come down because the EU is pushing forward on this. And I think that, you know, it is, as you said in your opening, Barney, a part of a suite of different ways of looking at sustainable finance and how is that being managed across the EU. And it's important to sort of take a step back and know that all of these layers of this slide really are trying to push forward by the EU authorities sustainable finance as a key driver to deliver the European Green Deal, as well as the EU's overall climate commitments. And we all know about the Paris Accord, the Paris Agreement, and we're all working up to COP26. Well, some of these regulations are one of the tools by which the EU is looking at trying to use finance to channel investment into sustainability and away from perhaps more polluting industries and regulations, et cetera. So post-COVID, the Next Generation EU Fund already has embedded in it requirements for deploying capital sustainably. Those recovery funds can't just go to anything. They are being directed specifically to more sustainable means. So how is it that that can be tracked? All of this fits into the whole that is delivering that European Green Deal. So what does SFDR specifically aim to achieve? SFDR is the Sustainable Finance Disclosures Regulation. So hopefully that'll answer the first question in your poll as to what it is we're talking about. And what it does is it aims to clarify investor duties, to standardize ESG product labels, and to crucially reduce the risk of greenwashing. Now, greenwashing is this concept that has been in our minds for many, many years. Personally speaking, it makes me very sad that we're still talking about it, but actually it's absolutely fundamental to getting this right. And greenwashing is the assumption that a definition of green is different between one party and another. And so being able to be very, very clear as to what is considered green within this jurisdiction is really at the root of SFDR and similar regulations. So the key objective is to increase the transparency of sustainability disclosures by investors and the comparability for end users and investors in terms of how they're deploying their capital. In particular, firms in scope need to disclose how they integrate sustainability risks and how they consider adverse sustainability impacts. What's been interesting with SFDR, and I'm sure the rest of the panel can comment on this, is it's been a bit of a moving feast. It was going to be fully deployed at the beginning of 2021, and it came even before that. There were mentions of it starting to roll out. Of course, COVID has put that a little bit further into the long grass. But to be clear, the level 1 requirements has been required to comply with since March 2021. So that's already in place. The level 2 compliance requirements has been delayed, and this has been the delegated regulations through the EU authorities. And they're looking at pushing that to somewhere around January 2022, but that hasn't been fixed yet. And of course, this delay and when things are landing is also causing a little bit of concern in the marketplace as to how it is that those that are in scope can comply and what else is coming down the pipe for them. So those key dates are causing a little bit of consternation through the marketplace. And I'm sure that Anna and some of the other panel will be able to guide us through what's happening now. But some of the key questions that you asked, so what are the questions that the investors are facing? Essentially, a lot of it is about product labeling. So SFDR requires investors to categorize their sustainable investment funds according to their level of ambition. So for example, we talked about Article 9 and Article 8. Article 9 funds, the ambitious type of product with a clear sustainability objective and may include a specific carbon reduction objective. And Article 8 is also a sustainable product, but a little less ambitious. It's dialed down a little bit to promote ESG objectives. So there are 2 different categories there that the fund manager, the asset management community would need to understand where it is that they would fit. Investors need to disclose annually and report on E or S features of any of the Article 8 or 9 products, ESG, environmental, social, and governance measures. So there are some adverse impacts that investors also need to be concerned with. Firms need to disclose annually, report on the extent that they consider their adverse impacts of their investment activities on environmental and social justice objectives at an entity and a product level. Negative externalities also need to be addressed, and they can include carbon emissions, biodiversity, gender pay gap. Investors need to disclose these actions and what they're doing to mitigate this. So it is very wide-reaching regulation, and it is designed for extreme transparency. So hopefully this gives us a bit of a framework, but I think it's fair to say that this is still a work in progress and only one piece of that European Green Deal.
Thank you very much, Sherry. Anna, just over to you. As Sherry said, this is a very wide-ranging regulation. So how does it fit into the wider EU Sustainable Finance Action Plan and regulatory agenda? And are there any challenges, both political and technical, that you foresee?
Thanks, Barney. And yes, as Sherry just said, this is still very much a work in progress, which is slightly worrying to say that when you've already had implementation since March this year. So the EU agenda, sustainability agenda, is vast, and we don't have all the time in the world. So I think what's crucial for this discussion is those live pieces of legislation that directly impact SFDR and how one can comply with it and meet those requirements within the regulation. And we just need to remember that this was one of the flagship proposals of the 2018 Action Plan. Initially, we were meant to have the taxonomy and then the disclosure, along with the low carbon benchmarks. But politics got involved as ever, and so we had things slightly the other way around, which means that the SFDR became the crux of this initial proposal, which would be moving investment and the capital markets into sustainability and sustainable investments as a means to meet those climate goals. So on the table right now, with direct relevance to SFDR, as Sherry's just alluded to, we still have the finalization of the level 2, the regulatory technical standards, which will dictate those pre-contractual and periodic disclosure for Article 8 and Article 9 products. And this is complicated, and we've had disputes between the supervisory authorities, the ESAs, and the Commission, or at least differing views and differing interpretations of that level 1 text, which inevitably leads to technical as well as political problems. What we've also got within that within the RTS will be those indicators for principal adverse impacts as well, which is all of relevance, and then for exactly the implementation in January 2022 and then through to January 2023. Now, the other big part of the agenda is, of course, when we hear about it a lot, is this ESG data gap. So within your SFDR disclosure requirements, you obviously need to be able to meet, to have the data to fulfill it. And so there, we've now moved on to where the corporates and the non-financial disclosures can help meet those SFDR requirements. And so we've had, as of April, this new NFRD, or the CSRD, which has a much broader scope and will also crucially draft mandatory sustainability reporting standards. We'll go into that a bit later in a bit more detail, but it is very relevant. And also what within that extended scope, you have entities that are within the NFRD and the extended scope now of the CSRD, who will need to disclose as per the Article 8 taxonomy disclosure requirements. And there are specific KPIs that you need to disclose to, and that all will help deliver the data that is necessary for this investor disclosure requirement. Now, also on the table, just to add to the complexity, this is answering your question, Barney, about the technical and political problems as we go along, by the way, because we also have the delegated acts of and product governance to MiFID, to IGD, FOD, UCITS. And there we have an added complexity in that you will end up, because they have now introduced an element of client sustainability preference within their choice of investment portfolio, you effectively have an added layer, a subcategorization of those Article 8 and Article 9 products. And these delegated acts are live, they're going through scrutiny, and it's actually a case of the industry needing to fill in the gaps of how this is going to work, and particularly engage with national supervisors to say, look, we're interpreting these delegated acts to mean X. Does this work for you? Are we therefore within our compliance? And then the final, but last but not least, is we have the taxonomy in general, which is what everything is meant to be aligned to. Initially, it was meant to be this amazing sustainability lexicon that could be exported across the world, and everybody would have a dictionary of what sustainability means. That is no longer the case. It's become so technically difficult. And of course, you have the 6 objectives within the taxonomy regulation. The first 2 being climate change and mitigation. That's the delegated act that we have on the table now. But even that is not as ambitious as it was initially meant to be because of political tensions. It does not include nuclear, natural gas, or agriculture within those first taxonomy objectives within the delegated acts. And we still have 4 more to come, and we also have another delegated act specifically on nuclear and agriculture coming up. So all very complex. And I think, Bunny, just to say the problem at the moment is that there has been a precedent set. We have an ambitious agenda. We have a climate obligation. And what has become apparent is from the EU's ambition is that level 1 timetable, the initial legislation, that timetable will continue and implementation will happen. But what has happened with both the low carbon benchmarks and now with the SFDR is that we're then going to see the actual technical details within these regulatory technical standards, the delegated acts. So from a compliance and an industry perspective, it's difficult because you do not have the whole picture and yet you need to comply. And of course, the political elements, particularly with the taxonomy, where you have different energy mixes in different member states and different support and ambitions around climate, all lead to, I'm afraid, a not simple procedure and simple process. And we're currently in a situation where nothing is quite yet solidified other than from those within the SFDR scope needing to comply at least with that level 1 obligation.
Thank you, Anna. I mean, yes, so taxonomy, MiFID, CSRD, level 1, 2, and everything moving. So turning to Corentin as somebody who has to solve for all these problems, as just summarized. So what are the sort of the unintended? So first of all, how difficult do you see that, Corentin, to solve for this from an asset manager, fund manager point of view? And do you think that there are going to be any unintended consequences because of the factors that we've just raised? And of course, do you sort of foresee reaching maybe to the taxonomy angle, comment of Anna, any divergences in the application around different parts of Europe to SFDR? So quite many questions, but how do you approach this problem? Any divergences and any concerns in the long run around that?
Thank you very much, Bernie. And that's a lot of moving pieces, and when you hear about them all together, it can be quite overwhelming. But thank you, Sherry and Anna, for a very good job at summarizing all the different moving pieces of the European ESG puzzle that we have to solve on a normal daily basis. I think in terms of how we cope and how we deal with all this uncertainty, the only way that we can approach it as asset managers is to deal with it one day at a time and to look at the different requirements as they come along and to try to build on what we know for sure and trying to make reasonable assumptions about what we don't know and trying to play it by the ear a bit. To go back to the SFDR itself, I think you asked me what was some of the unintended consequences of this regulation, and it's really interesting, I think, to ask this question only a few weeks after the regulation has been coming into effect, and it shows that it is definitely quite an interesting piece and quite a different animal in terms of legislation. Like my previous speakers and panelists said, there are a lot of uncertainties still at this stage because we have this phased-in application of the SFDR with applying the level 1 general principles before knowing about the definite technical details. So obviously that creates a lot of leeway, a lot of room for interpretation for market participants when they implement. But another aspect is that the text itself it develops a lot of new concepts, such as the principal adverse impact you mentioned before, or the product classification, or the idea of do no significant harm. So all of these new concepts that we are getting more and more familiar with, we still have to completely define them and have a common understanding of what they mean, what are their limits, their borders, and what they are and what they are not. So all of that creates a lot of uncertainty. But maybe to go back to product classification, because I do think this was the main idea and the main issue on the minds of asset managers a few weeks ago before the 10th of March. The big question was, how am I going to classify my fund range in those categories? So Sherry explained Article 9, products that pursue a sustainable objective. Article 8, product that promotes environmental or social characteristics, and the others that do not fall in one of the two previous categories, which are sometimes referred to as Article 6. So in this question, I think one of the main unintended effects of the legislation, beyond not having very clear interpretation of what it means, is the unintended effect that we have seen is that because Article 6 or a very broad catch-all category of everything that does not do ESG at all, so you can think about a money market fund or a fund that only invests in strategies on currency and interest rates, for example. They have no ESG integration whatsoever because that's not the strategy that they pursue. They fall under Article 6. But under Article 6, you will also find some funds that have minimum level of ESG integration that is not binding in the way that it's being applied. So it's discretionary for the portfolio manager to decide whether or not to act upon those ESG indicators or appreciations or risk or opportunities. But some of those funds that have, let's say, a baseline level of ESG integration also fall into Article 6. And the fact that Article 6 has both of those type of funds, not ESG at all, and a little of ESG but not completely binding, has created the incentives for the latter category to move towards Article 8 in order to be seen as ESG and to be recognized as such. And by the way, on the market today, a lot of the ESG offering of the last year is actually mostly on a non-binding basis or a discretionary basis, where you assess ESG as part of your general portfolio management function, and you decide whether or not you're going to take this ESG risk or you're going to take this ESG opportunity. So we saw this movement that, and also obviously you have some commercial perspective that you want to be able to offer ESG products to the clients. Of course, retail and institutional clients are more and more asking for ESG fund ranges. So one of the unintended consequences that we've seen and that we think is really worrying is that by forcing asset managers to classify their funds in this category, you can actually somehow incentivize a form of greenwashing to push some products into the Article 8 category when they could be in an intermediate other category between 6 and 8. So that's one of the unintended consequences that we have seen. I think then on other unintended consequences, obviously that we are already seeing some national divergences in the way that those notions are being interpreted, and even coming from regulators. We here in Paris have the Autorité des Marchés Financiers, who developed their own ESG doctrine on what you can call an ESG fund and what you cannot call an ESG fund, which is working on separate criteria than elements from the Sfdr. So it's not exactly matching these 6, 8, 9 categories. And we are seeing more and more, we are hearing it in Spain, in Germany, and in other markets that the local regulator wants to add another layer of regulation, which will end up in a quite blurry landscape when it comes to product classification.
Thank you, Corinne. I mean, lots to follow up on. But just as you mentioned, the local markets. Just going back quickly to Anna, we are in the UK. So how does the UK look like, and what differences should we expect between the UK and the European disclosure regulations?
Thanks, Bonnie. I have to say I have dual citizenship, so I have a very English voice, but I'm also Belgian, but there we go. But so what's happening, it's been really interesting because actually when it comes to ESG and climate ambition, the UK is as ambitious as the EU. And obviously we have COP26 coming up at the end of the year, which they're co-hosting with the Italians. What's been interesting in that transposition from post-Brexit and the regulation that's been that has come across to the UK, actually, when it comes to ESG regulation, the UK they've been oscillating because from a compliance and as a means to avoid complexity, given that there is still a lot of cross-border business, there is a logic in a copy and paste of what we already have in the EU. So that would be exactly the same disclosure as the SFDR. But actually, although that makes sense from a compliance perspective, perhaps, what they're now looking at is actually a sort of a lighter touch. So you have already a principles-based initiative. They are very keen that they would embed, as per the TCFD, recommendations, that you would have mandatory reporting, and that would probably come in a staggered level in 2003 and then at least by 2025. But exactly how that will be drafted, we'll have to see. And we have a series of consultations coming out from the FCA, looking specifically at that climate-related disclosure from asset managers, also looking at producing a green taxonomy. And there they would be looking, so the disclosure consultation was already coming out next month, with final rules sort of earmarked for the end of this year. Then from a green taxonomy perspective, there they would be looking to replicate the science metrics of the EU taxonomy, but they would use their new green task force to then have a look at that and see if those science metrics fit the UK market. And then there's also some sort of guiding principles to make sure that there is a trust in the market when it comes to ESG products and investment. And so there again, we're going to see a bit more detail around those guidelines. So I think the short answer is that the UK will be looking to find commonality from a EU to UK perspective. They will not be copy and pasting. And also they do have the advantage of being able to look at the experience of the EU and see what they could do, replicate but do better. But the devil, we'll have to see. The devil will be in the detail, and consultations are all imminent, and things will materialize towards the end of the year.
Thank you, Anna. And thank you, dear audience. We are receiving questions, and I promise we are going to get to them. But as we were talking about the sort of the no copy paste between the countries, we definitely saw no copy paste between version 1 and version 2 of the level 2 indicators. So, Andre, just giving the mic to you for a couple of minutes. What are the things that we really have to focus on and highlight between the different versions of level 2 documents?
Yeah, it's so interesting. So obviously the first version of the principal adverse impacts indicators, there we had about 50 indicators, with about 32 of those being mandatory. Moving on now to the latest final report, draft RTS of level 2, we've now got a total of 64 indicators, however, only 18 of which are mandatory. So we've got a smaller set of indicators to focus on that are mandatory, which can be seen as good. We have more opt-in type indicators too in the tables 2 and 3 of the latest PAI measures. In terms of differences as well, interesting that we've now got inclusion of sovereigns and supranationals, which were not in the original principal adverse impact tables, and we've also got, of course, specialized focus on the real estate sector. So there's in the mandatory indicators, as I say, there's 18 mandatory. There are 2 KPIs in there specifically for real estate, and there are 2 specifically for sovereigns and supranational investments. And just to give a flavor of what we're looking at here, so you've got environmental and climate matters. There's 9 measures focusing on that for the mandatory. So that's looking at greenhouse gas emissions, biodiversity, water, waste. Then you've got 5 mandatory measures around social, employee, and human rights matters. So that's gender issues, gender pay gap, board gender diversity, also looking at violations of UN Global Compact principles and OECD guidelines for multinational enterprises. So that kind of touches on your DNSH, your do no significant harm, and then exposure to controversial weapons. And then, as I said, the last 4 are your focus on supras and sovereigns and real estate. And it's interesting because it's not just about capturing the metrics. It's looking at the definitions that were provided in the Annex 1, because there's a lot of detail there in Annex 1, which goes hand in hand with these tables, and really trying to get on par with the exact definition of those with various data sets. So it's very detailed, and we've got very good detail on the formulas, how to aggregate, how to inform those aggregate views at a product level. So lots of detail in table 1, and then the remaining tables 2 and 3. I think you have to choose 1 mandatory from each of those, and the rest are opt-in. A lot of sovereign, supranational type measures as well, and also a great deal of environmental criteria. Also interesting to see a good amount of focus on biodiversity as well.
Thank you, Andre. I will, before we continue, I will turn to the questions the audience raised. There are quite good ones among them, I have to say. So maybe. I don't know, maybe to Anna or Sherry. So we heard all these different regulations, but of course then after that the natural question comes up: what are the implications for the financial market participants if not complying with the SFDR mandatory regulation? Do we have something on that?
Well, so current aspect to this as well. So you have national supervision of compliance. So if you're within scope, and then you are obviously you're going to be putting products and advising clients, investor products and advising clients, then within your scope, you need to make sure that you comply as per your national supervisor's discretion. And that's why this engagement with the national supervisor is so important, because they are adding a layer, perhaps, and Quentin mentioned the French, but other member states are doing the same thing, where from their national supervision perspective, they feel that they need to add a layer of oversight or added criteria to make sure that when, from an investor's perspective, you have the safeguard that your national supervisor is making sure that if you are being sold product or your portfolio will have a sustainability taxonomy alignment, or whatever you've decided, then it's really what it says on the tin. And that is why there is this added layer of national supervision for that compliance. Also from a product perspective, to make sure that they are correctly signed off as well. And so that there is that layer of at the EU level, but at the national supervisors close to the market, being able to keep an eye on what you're doing within the compliance.
Thank you.
Yeah, absolutely.
Maybe,
If you can add
go on.
Yeah, if I can add to that, Anna, I think I completely agree that it's going to play at the national level, and we have already received some queries from certain national regulators asking, how did you classify? How did you make the decision? Can you document this choice or that choice? The next step would probably be some nudging and recommendation, but then you can also go into more hardcore supervisory measures. The other aspect would be also, I think, reputational in terms of impact. So if you do not respect SFDR, and if you misclassify your fund, if you missell a product for what it's not, or you have to downgrade the classification of one of your products, you can be sure that your distributors and your clients will know, and it will not look good on you. So there is definitely a reputational risk here as well.
And maybe just staying with you, oh, go on. One more comment.
No, but it's exactly, and this is why this reputational element is why it's so crucial that we get this level 2, all of these different level 2 measures right, because you've already had to do your classification for March for the level 1 information, and then you're possibly going to have to reclassify. And what does that mean for your relationship with your clients? Because you have said this is as per the classifications as we now understand them. But if we're then going to have a reclassification, you are losing that trust in these ESG products, which we're trying to get the capital markets to shift into.
Yes, and I would actually raise another question around this. It comes from the audience, which is, so is there a best practice around classifying funds as Article 869? Obviously, there is the reputational damage, but if you are too conservative, then you are running the risk of not your funds not being bought, and and the market goes to other fund managers. So would there be any kind of best practice advice in this case? Or be conservative, because that's best.
I'm happy to take that one. It was definitely the question that we were asking ourselves between, do you want to be or do you want to have more of a compliance mindset and be conservative about the choices that you want to make, or do you want to be more on a more like strategic or commercial perspective when you make those choices? I think it's not one or the other. You can be very reasonable, and actually what we explained before with this reputational risk means that it's also being strategically minded and commercially minded to be conservative sometimes and to make tough decisions, because you don't want to downgrade. That's definitely the risk that you want to avoid in the future. So what we did, for example, at our firm is that it was really a conversation and really bouncing back ideas and trying to play devil's advocate, trying to construe how could that fund that you say is Article 9 could be construed as not meeting those standards that you say it meets, and then it was documenting all those choices that you make, especially when there are uncertainties, saying, okay, at this juncture it was not clear, so we chose this interpretation, so that you have the documentation and you can look back at the decisions that you made, and you can also show them to your regulator to show that you've asked yourself the right question. I think one of the key to SFDR is really to do what you say and say what you do in a real intellectual honesty. And I think if you do that, it should be fine.
Thank you. Just one more, maybe again, Anna or Sherry, to which extent are real estate investment banking concerned by SFDR? We are notably providing funds advisory and also now helping corporates disclose on ESG matters. Is SFDR only to be considered by our clients, or should we also report on ESG? So investment banking, real estate investment banking is the question.
Well, yes. So there are disclosure requirements under SFDR. You're looking particularly from an investment. So if you're an investment bank, that you need to have a look, and obviously from that real estate funds, there are requirements as well, but also from an ESG disclosure perspective. you have a financial disclosure obligation, but I mean, there's also from a non-financial disclosure perspective, you would be scoped into the new CSRD as well, which would be making sure that you are disclosing from that non-financial reporting perspective, which is aligned to your taxonomy objectives, assuming that you are within scope of the current NFRD. So I don't know if others might be able to add more, but the onus is on disclosure.
I see Sherry nodding, but I don't know if you want to add a few things. The mic goes anyway to you, because now we, let's say, concluded with the understanding of what the regulation is about. Obviously, that's maybe too much of a positive comment here, but just going to the challenges and solutions more in the second part of this webinar. So, what is the data availability that is out there in the market regarding PAI? If Sherry, I could go to you with this.
Sure. Thanks, Barney. I think it's important to say that all of the data that everyone could want in order to be able to clearly indicate what funds and investments are classified as green, it's not there yet. We're certainly on a journey, but there's more available than you would think. If you're just coming to this fresh. So I think that one of the guiding principles is don't let the perfect be the enemy of the good. There is a substantial amount of data that is out there that can be utilized, but there are known gaps and holes. And when we look at this, you need to think about sort of where it is that's the most relevant to you and your fund. For example, portfolio managers need to navigate regional differences in availability of data. For example, the carbon emissions disclosure are better in the EU, so that's about 69%, compared to global average of 43%. But I mean, neither of these are astounding numbers. We're not up into the 80–90% worth of disclosure penetration. So there is definitely work to do in that, particularly in Scope 3 data, which comes into play. But in some areas, and in particular, social factors may also play a role. So this whole do no significant harm element also includes some data points that are still just coming into the frame. When we talk about ESG, we talk about it as a sweeping statement. The reality is E, S, and G, environmental, social, governance. The environmental data sets are much more densely populated in certain very specific deep dives, which are included in the SFDR, whereas social and governance are a little less populated. They are growing, but again, it takes time for those disclosures to be available and for portfolio managers then to be transparent. I think in some ways we sort of need to default to some of this sort of big picture when you're talking about availability of data. Where we're all driving for, where regulators are driving, is that they want data to be coherent, comprehensive, and comparable, the 3 Cs. And that is always going to be an ongoing goal, especially as we start getting more refined as to what data sets we need in order to be able to match up and map to the PAIs in the SFDR, or indeed, the wider taxonomy mapping as to what data sits underneath that. It's a huge task because when we're talking about regulation, it's wording. When we're talking about data, we're talking about those foundational building blocks upon which you can use to comply. It's subtle, but it's fundamentally different work that needs to be done in order to be able to make sure that those one-to-one mappings start working and that the transparency is very, very clear there. I just mentioned the 3 Cs. I'm going to give you another 3, Barney, to think about as well, and perhaps cause some problems for the rest of the panel to help discuss as well. But there are 3 E's that we all need to consider when we're talking about data. When you're thinking about the incomplete data sets, there's a temptation to extrapolate, to estimate, and actually to understand where errors are. So those 3 E's also add risks into a portfolio manager's adoption of data. So quality data is actually fundamental, and understanding where it is that estimations or extrapolations are happening you need to go to that extra layer and really be comfortable and familiar with where those data sets are designed. Because those 3 C's matched with the 3 E's, trying to be cute here, helps you actually really understand how it is that it's not just about ticking boxes in compliance. It's actually making sure you're meeting the fundamental principles, which is not greenwashing what you're putting out into the market.
Thank you, Sherry. Very insightful. I mean, definitely the 3 E's. If we have time, we will discuss them. Estimations and extrapolations are very much, you know, coming into play, or at basically a kind of a ease, hopefully, or for some of the asset managers to fill in their data gaps or data holes even. But I definitely have the motto of the event: don't let the perfect beat the enemy of the good. So that's already, we keep that up there. Anna, just very quickly, Sherry mentioned the regulations and the help coming from the regulations. How does the corporate disclosure help filling these data issues?
Yeah, thank you. Yeah, absolutely. It should help fill this ESG data gap, because what we're looking for is, of course, you know, data from corporates. And so we had already the non-financial reporting directive. What's happening with the corporate sustainability reporting directive, this extended NFRD, is that you have a much broader scope of entities brought in. So you go from about 11,000 corporates under the current scope to about 50,000. And they will all be required to disclose information, and particularly within taxonomy Article 8 disclosure basis, which is really interesting and useful for the global asset managers and investment funds under the scope of the Sfdr, who need that to meet their compliance obligations. But what's also going to happen is, of course, this creation of these mandatory sustainability reporting standards. And there we've got the possibility for actually the disclosure agenda in the EU to also accelerate the global reporting framework when it comes to ESG, which would really help bring in that extra layer of data, as Sherry was just alluding to, which is necessary. But we've got to get it right. And so at the moment, the proposal within the CSRD is that you would have the underlying 6 objectives of the taxonomy regulation within that reporting scope. You'd also have this concept of double materiality within the CSRD, which means the impact of environment on the financial and then the financial on the environment, both ways. So all of this could really help. But then, exactly as Sherry just said, we still need these 3 C's. And so that's why, ideally, we need a consistency globally when it comes to these reporting standards, so that then we can make sure that there really is that comparison and fundamentally that investor choice with the database that we need.
Thank you very much. So, Corentin, over to you just quickly. So when it comes to you, of course, as an asset manager, so what are the main priorities to comply with the regulation? And to continue on that, and based on what you said, is there a way to actually make that a little bit more relevant to clients? So it's not just a compliance exercise, but it's some more. And maybe just to follow up with one question from the audience as well. How about third-party platforms, or how crucial will third-party platforms be for identifying and integrating these ESG risks? So if you could elaborate on these 3 questions in a few minutes.
No, indeed, a lot of challenges. I agree with what was said before. The accessing data and being able to compile them in a useful and meaningful way is definitely going to be the main challenge going forward. I think the product classification, unfortunately, remains a challenge because of all the things we said before. So faced with all those challenges, indeed, we sometimes ask ourselves, is it really going to be relevant for end clients? And I think when we try to respond to that question and trying to remain on the optimistic side, we don't want to think that this is not going to do anything. Obviously, this framework is not completely perfect. it's a new area of legislation. Some of the details need to be ironed out, and some of the concepts need to be clarified in time. But it is still going to dramatically increase the level of information that is out there concerning ESG in funds and financial services in general. So that's definitely something that is good. What we say to our clients, and especially the institutional clients, but I think it also is relevant for retail, is to look beyond the labels, look beyond those Article 8 and 6 or 9, and try to understand what it means, try to understand what the underlying methodology is, try to understand what the strategy of the fund is. And we do think that all of those disclosures will at least act as a conversation starter between an asset manager and their clients when they talk about ESG. It provides a framework, and even if it's imperfect at the moment, it's still a place to start the conversation.
Thank you. And you know, when it comes to, even we mentioned the regionalities, it also internally there can also be different needs as per different investing you know, mandates and ways, and maybe you know, entities. So how do you solve for that challenge as such? Is there a way to handle that?
It is a big challenge, especially in our organization, which is organized as what we call a multi-affiliate organization, where we have an umbrella company and more than 20 different independent asset managers working under us, and each of them having their very precise needs for data and strategies. So I do get this very big picture of what is the different needs of different strategies. And obviously a private equity specialist in France is not going to need the same kind of data as an ESG, as a pure player ESG asset manager that operates globally, and also not the same kind of data that a team that is specialized in natural capital projects is going to need. So there is no one size fits all. Actually, at the moment, we are trying to look at the universe of all the data that exists, either directly from companies, also with third-party providers, and trying to find the best solution. It is a gigantic effort, to be honest. Hopefully, well, luckily, we have a few more months to find that.
Thank you, Corentin. And just referring back to Sherry, Andre, there were the 3 E's: extrapolate, estimate, and errors. Of course, and we know about the disclosure statistics as well. So when we come to solutions on these missing data, what do we do? What can we do?
Well, unfortunately, there's not a million and one options. You know, we can basically work with information that's already made available from other companies, right? So we can extrapolate based on what other companies have disclosed and provide some different levels of sophistications in terms of estimates to try and fill in those gaps. But then, of course, there's the data holes where there's absolutely nothing. You know, there's no company reported data at all. And so these are definitely challenge areas. I would say, having spent some time looking at the principal adverse impact indicators, there might be a very few instances where there are holes. It's mainly gaps, and it does vary, of course, based on geography, market cap, sector, etc. So anyway, I think in terms of best efforts, estimates, people might, customers might adopt, more sophisticated estimate models to be more accurate. Others might just prefer to have very simple models that they can explain and reverse engineer easily. The other approach, of course, is engage with the companies themselves. So you can always approach them directly. They may have the data. It's possible. It might not have been published in their annual report or sustainability report. So that is another possibility. But appreciate that, you know, for some asset managers, that would be a huge task, you know, in terms of number of companies. So it could be a bit of both, but I don't see how you can, you know, pluck out numbers from thin air. You know, if you have nothing, it becomes a bit challenging.
Thank you, Andre. Just talking about data gaps and data holes. Of course, there is the identification problem whereby you have a fund constituent, and you really have to map that to the ultimate beneficial owner or the parent company. So just turning quickly to the audience with a quick poll, how do you get that information? If you could just push one of the responses so that we can see the results. Let me just check. And while we are waiting for that, there was a question coming in on the cost impact. So what kind of cost impact would you expect onto the final investors concerning the additional reporting activities coming from L1 and L2 reporting for the Article 8 and Article 9, and the progressive push towards these groups from the broader Article 6 universe? So cost impact, I don't know. Am I alone in this? No? Don't see the other speakers.
Yeah, the cost impact. I think the cost impact is really difficult. I think we would be very happy to know exactly how much it is going to cost to implement all of those new requirements. I think it's a bit early to say. So I think maybe in a year from now we'll have a better view about what will be exactly the cost impact. But there is obviously going to be one. Just looking at the amount of work that is needed and data that is needed to be gathered.
There was a question about basically about buy versus build. I think we have a response for that from the audience. So thank you very much, all. There is another question, if I may ask that before just we go to the concluding remarks. Should the investor know more things about the jurisdiction which they are not compliant with different international regulations, institutions? For example, how about the jurisdictions with, that are blacklisted because not compliant with AML or CFTs? I don't know. I'm guessing this is the multi-compliance question. Okay, then moving on.
If they're on, well, Bunny, if they're on the blacklist, then that would have to be declared anyway. So there would be a level of transparency of any, if that jurisdiction was touched, that you would have to disclose that if they're on the blacklist as well. Actually, at the moment, there's also a grey list. If you're looking at public country by country reporting, so tax authorities exchange, but also at a public level, there is also a grey list, which is in discussion, which then gets very tricky. But let's not jump to grey in this instance. Black is the one that exists.
Look, and as you are speaking, Anna, just very quick one, because there was a question. If the UK goes the way of light touch SFDR, will they not jeopardize the UK EEA equivalency discussions?
No, well, so the equivalence discussions are very complicated on many fact basis, and actually the fact that there has been so little equivalence granted to date actually means that the UK is looking at everything else it can do aside from expect equivalence. So obviously we have a limited equivalence decision for clearing until June next year, but we are not going to have an equivalence decision when it comes to trading venues. And so, yes, it helps. And there is actually within the drafting of, for example, the CSRD, there is an option for a third country equivalence of how you are meeting your non-financial disclosure reporting requirements. And so that's not an equivalence, but it's, it's not an equivalence decision as per an equivalence decision by the Commission, but it's an allowance that there will be reporting frameworks elsewhere, and it would make sense if there is an equivalence assessment, which means that that can also be used, so you don't have a cut-off when it comes to the end of your jurisdiction. But from an equivalence perspective, otherwise, it's more, it's going to be a choice. And whether if you want that market access, and if you want to be SFDR compliant in the EU, but you're in the UK, then you will need to comply with SFDR. And so if you're looking at a UK market and you've decided that actually there's enough of an interest in the market in the UK still, then if there's a lighter touch that the FTA produces, then you can sit with that. But what is more likely to happen is you would have two systems depending on where you're doing business, and that's probably the likelihood rather than there being an equivalence decision.
Look, we are at time, but I really need to ask these questions because I'm so interested about them. So just in one go, and as short as you can be, but would appreciate your answer. So Sherry, how can data initiatives, next to these, for example, CSRD, such as the Future of Sustainable Data Alliance, foster increased transparency in the market? To Anna, we have all the challenges and there is a lot of moving pieces, but do we think that the EU will play a global role in the disclosure and in sustainable finance regulation? And to Corentin and Andre, would you have a vision for SFDR 2.0? Over to you guys.
Why don't I jump in and be really quick? I'm delighted to be the chair of the Future of Sustainable Data Alliance. So I would say that we would love for more disclosure, more conversation, and more work on the work streams. Leaving you with this thinking, 98% of global institutional investors take ESG and sustainability data into account when they're making investment decisions. Those same investors have also said 83% cite data as the biggest obstacle to effective assessment of investments. So there's a big work to do. And if you think about that, that is the biggest gap that we have to close.
Thank you. Thank you, Sherry. Anna.
So as to being a global leader, I think the EU got off to a flying start. And it is now also on the EU to be able to finish what they've started and to get that technical drafting right. And I do think a lot hangs in the balance when it comes to delivering on the taxonomy. But the EU is there, and it has been a leading force. I mean, the fact that the Paris Agreement happened in Paris, I think, probably gives a sense of ownership and set a momentum as well. But the EU now needs to be that trusted partner, along with initiatives at IOSCO, G20, FSB, obviously IFRS Foundation when it comes to sustainability reporting standards. And so if they can bring the experience, be part of the initiative, then they can still play that leading role. And it would be such a waste of all of the work that's been done to date for them not to be part of that discussion.
Thank you. Corentin?
Yeah, thank you. So my wish list for the next version of SFDR 2.0, I think it could be very long. I'm going to focus on a few topics. I would say clearer definition and concepts, and I think it goes to a lot of the questions I've seen in the Q&A. What does promote mean? What does an objective? What is an objective? All of that is to be better defined. I would say also fixing some of the incentives to classify a product as one or the other category when it should not be. So rebalancing that, and also I would say having a critical look at all the disclosures that we're going to produce in a few years' time, and really ask ourselves, is it useful? Is it decision useful? Is it investment decision useful? Is it useful for end investors, institutional investors, retail investors? So having a critical look at what we're doing.
And course correct.
Finally, very quickly, I just agree there. And then more definitions. So keep keep rolling out the definitions for tables 2 and 3, please, because we need more clarity on those KPIs. So, yeah.
Thank you all very much. I hope the audience gathered some insights. Just drawing your attention to the resource materials. We discussed this, and we have end-to-end solutions how we can assist our clients, our partners. So refer to them if you're still puzzled. Look, I think the conclusion is it's still in moving. There is a lot of actions to do. There is a lot of things to hold in one hand. But I think that there is an optimism, at least among us, that we are going into the right direction. We have the 3 C's, we have the 3 E's, and say what you do and do what you say would hopefully not get you in too much harm. So please refer to our subsequent webinars in the future, check in, and kindly fill in the survey that pops up at the end of the session. Thank you for your attendance, your questions, and hope to see you very soon. And thank you to this amazing panel. It was an honor. Thank you. Bye.
Thank you. Bye-bye.
Thank you.